Good morning, everyone. Welcome to today's morning coffee with Mike. Got the coffee here, and I also have a very special shirt that I'm wearing today. Been for my friend Mike Webster. Sent him one of these a couple months back. Actually, it's a bit longer than that. I think it might have been a couple of years ago. Anyhow, he spoke about it on Twitter, so I thought that I would wear mine today. So, Mike, this episode is for you. All right. So, what are we talking about today? Today, we are talking about timing the markets, key indicators for buying stocks. Now, the reason why this is important right now is because if we take a look at the market, and I'll start up the presentation here. I got my face over that. Get this out of the way of the slides. But if I were to bring over some charts, right, well, let's bring over some charts just to give you a quick peek at what markets are doing. Markets changed quite a bit in the last week, right? Here are some weekly charts, and take off the annotations for a moment. Look at how bad the NASDAQ was and how much it improved this week. It's up 6% this week. That's insane. That is a huge amount. And that is the reason why that's the reason why I want to give you this presentation today, which is going to talk about timing the market, key indicators for buying stocks. So let's go through it. All right. So, how can you tell when it's time to start to test the waters? How can you tell when it's time to dip your toe back in and start to check things out? If you're looking at some charts, you might just see a bunch of squiggly lines on screen. If you are looking at spreadsheets, maybe this is, that's just a lot of data that's coming at you. Maybe you're listening to some fake guru, and I kind of feel bad for this guy. Well, when I typed into the AI to help uh, generate bits and pieces of this guy's image popped up, a fake guru. So don't know who you are, but yeah. And of course, the news. When is it time to get back in? Usually the news says that it's absolutely terrible, or that the time is terrible, the news is horrendous, the world is ending. When should you look to get back into the market? Well, forget about all those things. Forget about all of it. The way that this man here, William O'Neill, if you don't know who William O'Neill is, you should get familiar with this guy. This guy came up with a system that helps us to not only understand markets and find the best growth stocks in the industry, but it he also came up with a way where you don't really need to focus so much on what's being said. It's more about what's actually happening. And he came up well with this concept of a follow through day. So, what's a follow through day? In brief, a follow through day is a major sign that a market has bottomed or is starting to rally. What O'Neill also found is that every single bull market in history has had a follow through day. So sometimes it comes a little bit earlier, sometimes it comes a little bit later. Not every single follow through day works, but every single bull market in history has had a follow through day. That's why this concept was so important. And finally, what's the definition, right? How do we know what a follow through day is? It happens after the market has stopped going down, and it's an up day on an index of at least 1.2% on heavier volume than the day before it. In generally speaking, that is. And so when we take a look at the market, and I'll bring the indexes back over here, right? So here is a look at the S&P 500. When we look at a day like yesterday on the S&P 500, this constituted a follow-through day, but so did this here. Now, you might say if you were able to see the percentage up there, or if you actively follow markets, you'll see that that's up only 1% on the day, but the volume is up. So you might say to yourself, well, doesn't that contradict what you just said? I mean, over here, you said that volume or the price needs to be up 1.2% or more. And that's also something that I read in How to Make Money in Stocks. So, Mike, how could you say that? Well, the reason why I'm able to say that is thanks to this guy here. His name is Mike Webster. He's the reason why I put on this shirt. I sent that to him a little while ago. But he also worked with William O'Neill. He worked with William O'Neill for many years. William O'Neill passed away this year. God bless his soul. Mike Webster is a former SVP and portfolio manager for William O'Neill and Company. He was also an instructor at IBD Market School, Investors Business Daily Market School, from which I attended. And I learned directly from Mike, and I interviewed him back on the show. He also wrote a very nice review for the Trading Mind Wheel. Anyhow, Mike Webster did additional research on the follow-through day concept, and he said that the percentage that price needs to move is actually market dependent. So in this environment, he tweeted it out the other day, 1% was the amount. So great. So it's market dependent. So how do we know what should it be, right? Like in this market, it's 1%. In another market, it's 1.2. Maybe it's 1.7 in another market. How do we know what's proper, right? Not all follow through days are going to be created equally. There's other things to consider. Here's my solution to that question. How you're going to know? You're going to know by taking multiple things into account. And the things that I take into account are these three major buckets or zones here that you're looking at in this Venn diagram. So the first thing falls into the general market, and there's a bunch of things that can fall into the general market. As far as the general market goes, here's what I'm looking at. So I'll bring the charts back down just for a moment here. And so I'm looking at the price action on the indexes. I'm looking at all 5 major indexes. I know I've got 6 charts up here. This down here is an ETF that mirrors the kind of stocks that I tend to trade. But I'm looking at the 5 major indexes. I'm talking about the S&P 500, the NASDAQ, the New York Stock Exchange, the Russell 2000, and the Dow. I'm looking at those on daily charts, on weekly charts. Here's the weeklies. I'm looking at them on monthly charts as well, and that's how I'm looking at the general market. There's a few other things in there too. Look at distribution days. I look at follow-through days. I look at the number of stocks overall that are making new highs, new 52-week highs versus new 52-week lows, and those things give me a sense of the general market. Is the general market getting ready to turn? Is it getting ready to chop? Is it getting ready to potentially hit its head on resistance and fall right over? What's the general market doing? Next is your system. What's the system doing? The system part is how I'm screening for stocks, right? You could have your system be whatever you want. And over on Instagram a few minutes ago, I was telling someone about systems, and you could really bake whatever you want into your system, what you need to do for your system, right? What you need to do to influence how you're going to trade. It could be anything. If you don't have a system, right? If you think that you don't have a system and you're just kind of trading by the seat of your pants, then anything that comes to you, right? Like maybe you're listening to some guy on the internet and they have a great idea. And you're like, wow, that sounds like a great idea. I really respect this guy. Let me go place this trade. Well, guess what? That's your system. Not a very good system, right? We could do a lot better than that. So what you should do is think about all the different things that you want to place into your system, write it all out. You could literally put whatever you want, and whatever makes it onto that page, that is going to be your system. Anything that is not on that page is outside of your system and is therefore noise and should therefore be ignored. That's going to help you filter out 99% of the bullshit. So that's your system. And then finally, your personal performance. How are you performing? That's important too. And the reason why is because if you've built your system, then your system should also guide you to the best trades, right? Well, whatever you perceive as the best trades. So if whatever you perceive as the best trades are doing well, then it logically follows that, hey, it's a good time for you to be invested. If you start to have losses, then you should be scaling back. And that's how you could use this all three of these things right here, general market, your system, and your personal performance to help you fine tune how you're going to operate in the market. And so I talk about all the specifics that I do over on my website and my content and my book. So go follow along with all that stuff. You'll get a lot more info that way, a lot more than I can do here in a single live stream. But go to marawolf.com and check out the content over there. And for now, let's answer some questions. Let's see what questions came in. You guys over here on YouTube, Facebook, LinkedIn, Twitter, get your questions in. You guys over here on Rumble, I see a few people watching over here on Rumble. Welcome, welcome. Type your questions into the chat. I'm monitoring both areas here. I've also still have Instagram up, so I'll scroll through Instagram while I'm waiting for some of you other guys. You could literally ask me whatever trading questions you have, and I'll do my best to answer them for you. Okay. First question. I see the VIX is at support 15, and I see it is a reversal candlestick today so far. We'll have to wait for the close. Okay, so that's more of a comment, but let's take a look at the VIX. Okay, so I'll drag this down. This, by the way, is TradingView. For those of you that are thinking about charting platforms, right? Like, so if you're brand new to trading, some people might think, oh, I'll just go to Google, type in the whatever I'm interested in, and just take a look at those charts. Those charts suck. What you want is a legit charting platform. TradingView has a free version. They have multiple upgrades if you wanted to do the paid. I'm using the paid version, but uh, definitely use something like TradingView or a real charting platform. Don't just go to Google and find those little mountain charts. Anyhow, yeah, so here is the VIX. The VIX is fairly low. So that's, I don't know, that's interesting. Less volatile. And I'll look at the VIX every once in a while. I'll look at the VIX when someone has a question about it, whether it's on here or someone in my group. But I'm generally not using the VIX period, and the reason why I'm not looking at the VIX so much is because I'm allowing the stocks to tell me the story. So if I'm seeing volatility in the stocks, then I'll start to see volatility show up here in the VIX. So it starts to become a extra thing, right? Like, so you could use VIX perhaps as an indicator, but for me, I don't really use it. Next question here. Question from I am third. Welcome, welcome. How did you control your greed during the follow-through days? Great question. Great question, because here's what one of the things that O'Neill says in How to Make Money in Stocks, and one of the things that many followers of O'Neill's work and Can Slim is that when you see a follow-through day, right? Bring the charts back up. When you see a follow-through day, you should buy something. Right? Well, when should you buy something? Buy something at the end of the day? Just buy a stock? What should you buy? So I had that dilemma, and I was very curious about that for a very long time. What I've done since then is that I will own, for me personally, right? There's other solutions for this, and we'll talk about those as well. But my solution has been I will only buy stocks that I have seen, that I have viewed the setup, and I have analyzed. So if I'm not seeing a high quality setup, then I'm not going to buy it. Follow through day, no follow through day. If I find high quality setups down here, right, as the market is looks like it's going to fall off of a cliff and as it's breaking down, if I'm finding high quality setups down there, then I will place orders for those setups. And if they trigger, then great, I'm in. Because if, let's say, a stock is setting up right down here when the market looks like absolute trash, then I take that as a potential sign that the market is starting to turn. Because if I'm looking for market leaders, then the leaders should be starting to set up when the market looks like crap. And if the market doesn't turn around, then I know that it's starting to roll over. And so, why take a trade down there? Why is it risky? There's ways to mitigate that risk through our position sizing, and that's something else that I learned the hard way. And it's one of the reasons why I wrote the Trading Mind Wheel book, because there's so many things that I learned. I learned a lot of great things from a lot of great people, but it was from one book, one from another book, something from somewhere else. So I wanted to take all that and put it into one area. That's why I wrote the Trading Mind Wheel. All right. So the other way to control greed during a follow through day, or what should you buy during a follow through day, you could buy the ETF, right? Like, so you could simply buy QQQ, or you could buy IWM, or you could buy SPY. All of those are the sector, or not the sector, the index ETFs, right? So that's the S&P 500. IWM is the Russell 2000, and QQQ is proxy for the Nasdaq. So you could simply buy any one of those if you don't see a particular stock setting up, and you could come up with a set position size that you would buy in that scenario. It's great to think through those types of things long in advance of what you would do and how and why. It's like playing chess, thinking a few moves ahead, and that can help you out in these times. So that way, when a follow through day does come, you're not there wondering, oh, what should I do? What should I do? Planning ahead is the answer. Great. So, what other questions do we have? Uh, let's see here. YouTube, Facebook. You guys over here on Rumble, still see you guys over there. Get your questions in. Come back over here to Instagram. Instagram is watching behind the scenes. So the follow-up question about the VIX is, how do you keep the guesswork out? The way that you keep the guesswork out is exactly what we were saying before. When you go and you write down everything that you're going to put into your system, the greater clarity that you have, the easier all this stuff is going to be. So when you're starting out, right? Like, it sounds like you're on the newer side. And I remember this too, right? Like, well, what do I write down? There's so many things that I could write down. Yeah, that's going to be part of the process. That's part of the challenge. So when you start to write out what you're going to put into your system, you don't know if it's right or wrong, but the way that a great basis for what you're going to put into your system shouldn't just be random stuff or just from somebody that you happen to be following. It should be somebody that's had a major track record and has had success. And not only that, has been able to teach other people their model, right? Because somebody could have, let's say that you found the person that had the world record, right? Like, I believe Dan Zenger, it still holds the world record for swing trading. I think at about 10,500% in 2 years or 18 months. But let's just say that you found an unknown person that made 50,000% in a year, right? Sounds amazing. But what if that person was an absolutely terrible teacher and the process was ultra complex? Is it good for you? Well, not really, right? If they've achieved something great, but it's so ridiculously complex that you can't learn it, and they haven't been able to teach it to anybody else, then what? It's great that they've achieved this stuff, but well, what? There's not educational value, right? Part of the educational value is the transference of that education. So one of the reasons why I follow O'Neill or started to study O'Neill uh, about what is it, 13, 14 years ago, is because not only did he have a great system, but he was also a fantastic teacher. Same thing with Mark Minervini. Uh, Same thing with guys like Jesse Livermore and Nicholas Darvis that lived quite a while ago, all of a similar mindset of trading growth stocks. So that's why I follow the people that I follow, and that's what I would recommend that you do too. Model success, figure out what they followed and why. Start there as a basis. Try to do well what they're doing. If you could find a person that's doing it right now, then go hire them to be your coach, and then you'll be in a great position to ask questions and get feedback and fine tune your process so that way you could have success as well. That's why I built the programs that I've built, right? So if you come over to our program, right, well, we have a Mara Elite Premium and Mara Elite VIP. That's where you get to work directly with me, and I show you exactly what I'm doing, why I'm doing it, and I give you all this information well in advance, right? Like I'll send it out the night before. I come up with all my trading plans the night before. I send it out, and then the following morning, you can go and place the trades or learn from them, right? Like it's not meant to be advice. It's meant to be, here's what I'm doing. Here's why I'm doing it. Please ask me questions so that way you could learn the whole thing, right? Like, so it's not about handing you a fish. It's about teaching you how to fish. And there's loads of stuff inside the program. So go to marawealth.com and go click on services and you'll learn more. Let's see, well, what other questions you guys have? We've got about 5 minutes here. Okay. Taking a real-time example, SQ. Let's take a look at SQ. SQ. All right, so the statement is real-time example SQ, it soared 15% after earnings. Opened up at $52 and now is at 49 and a half. I sold at 50 and a half. The average price is 47.65. What would you have done? Would you have sold it or would you have waited? Well, that for me, that this wouldn't have been one that I would be in with. In I wouldn't have been in the stock because it wasn't setting up in a way that in a setup that I trade. So that's the first thing. One of the first things that we need is clear definitions of our setups, right? So uh, if like remember when I was talking earlier about systems and process, and you could write whatever you want on the paper. If this here is a setup to me, then it would be, okay, this is a setup. Is this a high quality setup? And then I would need to go through the checklist to see, is this a high quality setup? When I look at this, I don't see a pattern that I trade. So it 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 misses the first criteria. So I wouldn't even be looking at this. But to give you an example of one that I did trade today that I just bought, it's Path. Right? So this is a stock that I saw setting up. This was on the radar yesterday. So I run my screens towards the end of the day. I look through all the different stocks that I find that are setting up in patterns that I'm interested in. This one was one that I was interested in. And then I started to dig into it. And lo and behold, it was a high quality setup. So I did more work on it and I found out that, okay, I would want to enter at 1675 and have a stop loss down here at 1597. And just to give you a little insight on why those particular levels, 1675 would get me above yesterday's high. Plus, it would get me above that blue line right there, right? You see that blue curved line? That's called an anchored VWAP, technical term, anchored VWAP. Anchored VWAP stands for anchored volume weighted average price. So basically, it's taking a look at all the price action from wherever you anchor it from, taking into account the volume, and it's saying, hey, this is where there's more buying pressure or more selling pressure. So basically, from down here, whenever price would hit that blue line, it would act as resistance. So part of what I'm looking at over here, right, at 1675, is if price could break above that on some heavy duty volume, which it was, then this could be a nice breakout, a nice momentum play. And so far, that's what it's turned out to be. And the reason why I'm interested in having a stop down here, right? So if price were to turn around and uh, this trade wouldn't work out, then I would want to cut my loss very quickly. And the reason why I chose this spot down here at 1597 is because it's below that day's low, right? Below yesterday's low. And it's also below a few key moving averages. It's below the 200-day moving average. Now it's below the 21-day exponential moving average. It also has the 10-day exponential moving average. So there's multiple layers of confluence that price would need to fall through to stop me out. So all of that information there, plus the where I'm looking to start to take my first scale outs at 5% and at 10% if price gets there, all of that was shared with people in our Mara Elite program yesterday, right? Yesterday evening. And they're going to continuously get updates as the trade progresses, as I update my plans, and it's all very easy to follow. I follow the same methods that, well, when I was trading part time before I left the corporate world to come do this full time. I'm still following the same methodology, so it's very easy to follow if you have a full time job. So, anyhow, that is that. And I believe we are out of time. So, for those of you that are watching, thank you so much. Go to marawealth.com if you haven't done so already. Make sure that you get onto our newsletter. We have a weekly newsletter that goes out every Sunday. There's lots of education in there, lots of free goodies. I even share some of the trades that I'm interested in for the week ahead. So get onto the newsletter. It's free. And there's a lot of additional education on marawealth.com as well. So go check that out. Until then, I will see you guys next week. Have a wonderful rest of your weekend. Take care. Much love. Peace out, everybody.